Hello, good evening everybody. Welcome to class. I'll just plug in my charger. Give me a minute. Okay, so I hope I'm audible to everybody. Alright, so today we are going to discuss about the revenue and the cost concept, and this is important because we have done the different structures of market, and now we have to study about the equilibrium in different market structures, like how the equilibrium under perfect competition is attained, how is it arrived at in the monopolistic competition with the help of graphs and revenue and cost analysis. So that is why the topic for today, that is revenue and cost concepts, is an important topic. Okay, so we can just start. So these are the key terms which we must know once we are discussing about this particular topic. So you all, the equilibrium price, short run, long run, then revenue, cost, economies and diseconomies. So out of this, economies and diseconomies has been covered in one of the previous classes. Ash and good evening. This economies and diseconomies have been discussed, isn't it? Then we have discussed about short run and long run also, like long run is a period less than a year, and short run is a period less than a year and long run is more than that. Then equilibrium price. Equilibrium price is the point at which the demand and supply balance each other. That is the equilibrium price. So the main thing for today is revenue and cost concept. So these are the subdivisions of the concept of revenue. There is total revenue, average revenue and marginal revenue. Then for the cost, there is total cost, average cost and marginal cost. Alright, so now we'll be seeing each of these in detail. Is it clear, everybody, so far? Alright, so what is the equilibrium price? It is the price at which the quantity demanded is equal to the quantity supplied. Then what is demand? It is the quantity which a person is ready to purchase and having need on that particular price in that particular time period. Like, there's another related term, that is desire. So I think you already know the difference between demand and desire. Can you just write it, the difference between demand and desire? What is demand? What is desire? Or what is the significance of this term? Okay, desire is only willingness. What is lacking in desire, Rajiv? What else do we need to convert it into a demand? Yes, very good. Demand is the ability and the willingness to buy, and desire is just the willingness. Okay, I am sitting in India right now and I have 5,000 rupees in my account, okay, bank account, and I have a desire to watch the final of the World Cup cricket in Australia 2015 final. So that is a desire or a demand? I demand to see it or desire to see the final? It's just a desire because I don't have the purchasing power to satisfy my desire. It is not backed by my purchasing power. Okay, in 5,000 rupees I cannot fly to Australia to watch the cricket final. So that's just a desire. If it would have been a demand, I should have had the ample money with me. So that's the difference between the two. Okay, I don't have the ability to satisfy my desire. So that's just a desire, not a demand. The next is supply. It means the volume of the goods available in the market at any point of time. Demand and supply is always analyzed on time basis. Okay, it is always backed up by a time frame. It can be for, the analysis can be for 1 week, 1 month, 7 months, whatever. Then what is cost? Cost means the amount of money spent to produce the goods. That is simple. Everybody knows that. Then revenue is the amount of money earned after selling the production. The sale proceeds. That is the revenue for any company. So far the things are clear. Can I just go ahead? Okay. So let's just revise equilibrium price once. So this is equilibrium price. This is the graphical representation of that. It is the price at which quantity demanded and quantity supplied are equal. So like in this graph, DD is the demand graph and SS is the supply curve, sorry, not graph, and they are cutting each other at point E. So E is the or rather OE is the equilibrium quantity of equilibrium price. Not OE, it should be P actually. It should be P here. So OP is the equilibrium price and OQ is the equilibrium quantity. Alright. This is simple. Now let's go further. Now what is revenue? It means the earnings of the firm. So example, a seller is selling 20 units of the commodity at rupees 20 per unit. So his total revenue will be 400. 20 units at 20 each. So 20 into 20, that makes it 400. That is a simple mathematical calculation. Now the revenue is divided into 3 types: total, average and marginal. So the concept of total, average and marginal in economics remains the same, okay, as have been discussed in the previous class when we were discussing about the utility analysis, and then we were discussing about the that production function, if you remember, land, labor, capital. So in both those topics, whatever was the concept with regard to total, average and marginal, that will be the same. Okay, so total revenue means the total earnings from the sales over a certain period of time. So total revenue is equal to price into quantity, price of per unit into number of units sold. Then average revenue means revenue per unit sold. Simple mathematics. Average means the total divided by the number of units, that concept. Then marginal means addition to the total because of one extra. So it means the change in the revenue when output changes by 1 unit. The extra revenue which we get on the sale of 1 additional unit. So we can define it graphically like this: total revenue is equal to n plus 1 minus total revenue of n. Now is there another way to write the marginal revenue? Is there any other formula in which we can represent total revenue, marginal revenue? Yeah, so can you just write it in the chat box, Prabha? Okay, you forgot. Anyone else? Rajiv, do you remember? How do we represent total? We represent the concept of marginal in economics. Okay, so we can also represent it like this: marginal revenue of n units minus the marginal revenue of n minus 1 unit. Okay, like this n may be 9 and this n minus 1 will be 8. So difference between the revenue of 9th and the 8th unit, that will be the marginal revenue for a particular unit. Okay, now there is a revenue schedule given. First we'll have a table and then we'll have a graph. So that shows the relation between the output and the revenue. So here it is. So this is the amount of units sold, the price, and then total revenue, and then marginal revenue. Okay, so let's see it in detail. The the price or the average revenue for 0 units is 30. Now is it correct or this is wrong? Okay, Prabha is saying it will be 0. So that means this 30 is wrong, isn't it? Anyone else? You have something to say about this? This price column, is this 30 is by mistake or is it rightly written over here? Rajiv, Kelvin, Muhammad, Ajit, Monachin, Ashin, Shabnam, Rinin. It's right. Okay, Rajiv, can you just elaborate on this? What is that 30 for? Okay, price shall be decided before selling. All right. We can, whether we keep 30 over here or 0 over here, that will not make any difference. Okay. So we can keep it 0 to avoid any kind of confusion. Yes, that is what I am saying, to avoid the confusion. If we look from the perspective of price, we can keep it 30, but when we are talking about average revenue, it should be 0 only, to avoid the confusion. Okay, Ashton, you are saying what is N? N means the number of units that have been sold. Okay, so we can see that in the graph, the price or average revenue is decreasing. Okay, per unit it's going down. So how do we calculate the total revenue? For first it will be 1 into 29. For second it will be 2 into 27. Then 3 into 24. So 72 is the answer. 4 into 20. 5 into 16. Then 6 into 12. Okay. So that is the total revenue column. I think the calculation is clear to everybody. Total revenue, it's P into Q. P means the price of 1 unit and Q is the total units sold. So we have multiplied these two columns to arrive at the total revenue. Just have a look and ask any doubts if you have. MR should be 0 instead of 29. Yes, Rajiv, that's very correct. It should be 0 because there cannot be any marginal concept for the first unit. So it should be 0. Okay. Then coming to the third column, the students who haven't attended previous sessions like this one, in which such concepts have been discussed. Is this thing clear to you? Ashin, Shabnam, I think you haven't attended those sessions. Ajit, Mohammed, Tariq, is the calculation of total revenue clear to you all? They are not answering. Strange people. Okay, Ajit, thanks for that. Alright, now coming to the concept of marginal revenue. Now, how is this marginal revenue calculated? It is simple. We subtract the revenue from the total revenue of a unit from the subsequent unit's total revenue. Like if we have to calculate for number 2, the second unit, it will be 54 minus 29. Then it will be 72 minus 54, that is 18. For the fourth unit, it will be 80 minus 72, 8. Okay, marginal means addition to the total. It is for the new students. It is addition to the total because of one extra unit. So this was the previous price. Price for 3 units was total revenue. The total revenue for 3 units was 72. And for the 4 units, it became 80. So what is the change to the total? It is 80 minus 72. So that is 8. Okay. We subtract 80 from 72. Then we subtract 80 from 80. The answer is 0. Then 72 minus 80. The answer will be minus 8. Okay. So now that means the marginal revenue has started becoming negative now. It is declining and now it has reached negative point. Alright. Is this clear to everybody? This column of marginal revenue. Rinin, is it clear to you? You have attended previous sessions, I think. Shabnam, Ashen, Ajit, Kelvin, Muhammad. What about you all? Okay, if it's clear, then we can go ahead. So, what is the relationship between the average revenue and the price? So, in this chart you saw that we are writing two things on this column. It is price also and it is average revenue also. So, this is not correct, but let us see how and why that has been written. So, we know that average revenue is equal to total revenue divided by the total number of units sold or the total quantity sold. So it's TR upon Q. Now what is this TR? How do we arrive at total revenue? It is price of one unit into number of units sold. So P into Q upon Q. P into Q upon Q. So as per the rule of mathematics, this Q and Q will cancel each other. So what is left is P. So P means the price of one unit, the price of each unit. So that is why we can say that average revenue is nothing but the price itself. Okay? Is this clear? Prabha, did you get this? Okay, Kelvin, you are not answering today. Rinin, Shabnam, Ashen, did you understand? Muhammad? Okay. One minute, I am drinking water. Just a second. Okay. So what is the distinction between the demand and the revenue schedule? So let us see that. So demand schedule and revenue schedules, they are interlinked. They are related to each other, but they are not identical. They are not exactly same, because average revenue is equal to price per unit. The relationship between the quantity and the price is of course the same as the relationship between the quantity and the average revenue. Yes, instead of price we can write average revenue because they both are identical. So how we are going to derive the revenue from the demand schedule itself? Let's see how. So you can see here is a demand curve DD for the product of a firm. So for drawing the revenue curve, we have to show the total revenue at different levels of output. Okay, the revenue which we get at different levels of output, and for calculating the revenue, the formula is multiply the price per unit with the quantity sold. So suppose we talk about OB units of units sold. If OB units are sold, the revenue will be OA, that is the price of one unit, into OB. OB is the quantity sold. It's going by the formula P into Q. This OA is the price per unit, and this this OB is the quantity sold, Q. Okay, so the answer is OAEB. Similarly, if we talk about OH units, then at OH units the price per unit has come to C. So it will be OC into OH, that is OCFH. So in this way, from the demand curve, we can calculate the total revenue at all levels of output. So we can calculate it for any unit of output. Like for this unit we can calculate, for this unit we can calculate, even for higher units we can calculate. Okay, it will be, this will be the price, let's keep it X, and this will be the unit sold. So it will be OX into OY. So this is why we say that from the demand curve only we are going to get the revenue schedule of a firm. Alright, is this thing clear, everyone? Okay, what about others? Okay. Now, if we are going to plot that table, the schedule which we saw in previous slides, if we are going to plot it on a graph paper, we'll get a curve like this. So this is the total revenue curve. That means initially the total revenue is increasing, it's rising, and then at point A it has reached its maximum. Okay, it is maximum at this point, and now it has started declining. So if we just look at that graph, yeah, that one only. So we can see that initially the total revenue is increasing from 0 to 29, then 54, 72, then 80, again 80, and then negative. So it's now going down. So this is what has been plotted in that graph. Now next. Now price elasticity of demand. How is total revenue and elasticity of demand related? So if the good is elastic, means the elasticity is more than 1, then in that case, if there is a change in the quantity sold, if there is an increase in that, then the total revenue will rise. If it is unitary elastic, means the elasticity is just equal to 1, it's not more than that, it's not less than that, then the total revenue will remain unchanged. Yes, Prabha, it's a little tricky if it's inelastic. Suppose salt. For salt, the elasticity is inelastic. Whether it's expensive or it's cheap, the quantity of consumption will remain the same. So for that, the total revenue curve will fall. It's not very much needed in our analysis. We can just have a look at this. So if we calculate it on the demand curve and the total revenue curve, if we calculate it together, then we can get some idea about it. Okay, so just look at this one over here. The elasticity of price is infinity, means the elasticity can vary to any extent. So for that, the total revenue will be 0. If the elasticity is more than 1, total revenue will increase. If it is equal to 1, total revenue will be maximum, and in fact it will become stagnant at that point. If it is elasticity is less than 1, it should be less, it should not be more, the total revenue will start falling. Okay, and when it's equal to 0, elasticity is 0, then it may become it may also become 0 and in fact negative. That is just a comparison. Alright, now next is the relationship between total, average and marginal revenue. Now what is the relation between the two? Now there are two things in this. The first is when the firm is selling the product at a given price. The given price, what is the meaning of this? Who gives this price? Prabha, we need not discuss this one in detail because this is just an analysis. This is not what we are concentrating at. We are more focused towards the revenue and cost concepts. Okay, because revenue and cost curves will be used in the further analysis. Now can I go to that one? Yes. So there is a term written over here. Everybody just look at this. It says it sells its product at a given price. Now who is giving this price to the firm? From where is the firm getting this price? Okay, and who decides the price in the market, Raji? Very good, excellent. It's decided by the free play of demand and supply. No Prabha, no Prabha. That is not what we are discussing right now. Okay, that cost and profit thing. We are right now discussing from the point of view of demand and supply only. Alright. So there are two conditions here. One is this, and when it is selling at a less price also. But that is also a possibility. So we will be discussing that. So this is about a perfectly competitive market in which the price is determined by the industry. That has been discussed in the class of various market structures. Okay, so we see this is the output, this is the price column, this is the total revenue. It will be 5 into 2, 5 into 3, 5, 4 and 5 into 5. So we are getting a total revenue. Then average revenue will be total divided by number of units. So for 1 it will be 5, it will be 5 again, 5 again, 5 again. Then marginal will also be 5 in this case. So what is the conclusion? It is that the average revenue and marginal revenue are equal to each other. It is 5. So if we plot it, we assume this point to be 5. Okay, so if we plot, so for every unit, for whether this unit, this unit, this unit, for every unit the price is 5. Okay, so it will be average revenue is equal to marginal revenue and total revenue is going to go up. It's going from 5 to 10 to 15 and so on. Alright, is this clear, everyone? The plotting of this. So this is under a perfect competitive market, and this is what we focus at, because we have discussed or we have seen that in a perfectly competitive market, the price is determined by the industry and no firm is allowed to sell at a price lower than the industry price. If a firm is doing that, then that firm may be thrown out of the market or the industry. So keeping that in mind, we must understand that this is the main analysis that is going to help us. Now, the second condition, in which the firm sells its product more at the reducing price. In order to enhance its revenue, the firm may just lower the price. That can also be seen. It all happens at the time of sale and all. So over here, this is the price per unit that is continuously declining. Total revenue we have calculated, 9 2s are 18, 8 3s are 24, then 7 4s are 28. Then next is the average revenue. So it will be again 18 divided by 2, 9, 24 divided by 3, 8. So we can say it will be similar to the price per unit. Both the columns will be similar. The next is marginal. Now how we calculate the marginal revenue? It will be 18 minus 10. So it will be 8. 24 minus 18. It will be 6. 28 minus 24. 4. 30 minus 28, it will be 2. 30 minus 30, 0. 28 minus 30, minus 2, and then minus 4. Okay. Now, keeping that, if we plot a graph, what we are going to get is we are going to get curves like this only. Okay, it will be the total revenue curve. Instead of starting from 0 or O, it is starting from this. It is starting from this point 10. Okay, this is 10. Because for the first unit also it is total revenue is 10. So it's 10. So total revenue, same shape, increasing then decreasing. Then average revenue and marginal revenue. Let's see that the average revenue is decreasing, but it is decreasing at a rate slower than that of the marginal revenue, isn't it? Can you see, when it is 8, it is 9. It is 6, it is 8. It is 4, it is still 7. It is 2, it is 6. It has reached 0, but still it is 5. Now marginal revenue is negative, but average revenue is still positive. It's 4. This is minus 4 and this is still 3. So it's decreasing, but it is decreasing at a lower rate or at a slower pace. So that is why we see that average revenue curve is always above the marginal revenue curve. Okay? Because if you are going to plot these points, we will get such curves. So this is the reason why average revenue curve is always above the marginal revenue curve. Because average revenue decreases but at a rate slower than that of the marginal revenue. Is this thing clear, everyone? So this is the reason why we have such a shaped curve. Because you can get such questions at times. Why is average revenue curve above the marginal revenue curve when the firm sells at a lower than the industry price? Okay, one-liners, so you can answer it. Now going further, this we won't be discussing because it is purely mathematics. You can see it's a theorem based question. So we'll just skip this part. So that was about the revenue. So we have discussed revenue under a perfect perfectly competitive market or in perfect competition. Okay, now we come to the cost. So cost means we know the cost of production. So for every factor there is a cost of production. For labor the cost is wages, and for capital it is rent or interest. Now let's see the different types of cost. Private cost. What is that? It is the cost of production borne by the proprietor or partners. It's like the cost of producing steel by the Tata Steel Company, or you must be knowing about the term drawings. Drawings in case of business. Accounts. Drawings. You know what is that? Drawings? Drawings in business. Accounts. Is that some type of sketching? What is drawings? Rajiv? Monachin? Prabha? Kelvin? Drawings means not income, Monachin. That means like the money that is withdrawn for personal usage. Pocket money, we can say. Pocket money of the proprietor. Okay, instead of taking the salary and all, he takes a monthly drawing. So that is that. So that is a private cost. Then social cost is the sacrifice that the members of society have to bear for carrying out the production. Example, yes, personal expense, Prabha. Money taken for personal expenses. Example, the water tax, the air pollution. If like the factory is spreading some kind of pollution, what measures are taken and the costs incurred, that all will form a part of social cost. Then money cost is the most obvious cost, the cost of raw material, labor, cost of running the machine, all that. Yes. Then real cost is the cost expressed in terms of the volume of inputs required to produce a particular quantity of output. Okay. Real cost is the cost that is measured in terms of the input that are needed to produce a particular quantity of output. So with good evening, welcome to class. You are really late today. Okay, then the next is explicit and you want to see the previous slide. There was nothing in that, Prabha. I don't think there was anything written in that. It was about just a minute. This was the previous slide. Okay. The last one. This one. Private, social, money and real cost. That. Is that fine, Prabha? Now can I go to the next? Explicit and implicit cost. So, okay, you are noting, I think. So what is explicit cost? Explicit cost is the 1 minute. Oh, sorry. Okay, so explicit costs are those which are associated with any business, and they are like this is about the real money which is paid to the third parties, which is paid out of the business. So it is also known as out of pocket cost, like salaries, which we pay to our employees. The price that is paid for the raw material, for the machinery, the equipment, that all is explicit. And we can also call it money cost or accounting cost. Then next is implicit cost. Implicit costs are those which are not paid in terms of money, yet such costs are incurred and they have to be borne by the business. The best example of implicit cost is depreciation on the machinery. Okay. You understand the meaning of depreciation? Depreciation means whenever a machinery is used, that will deteriorate with passage of time. So we in business, we make provisions for that depreciation. That is treated as a business cost, as a business expense, and we make accounting procedures for that. So that depreciation is an example of implicit cost. It is a hidden cost. Or to be more clear, we can say they are non-expenditure cost. The examples are salary of the proprietor, the interest on the entrepreneur's own investment. He is investing his personal money, so the interest that is paid on that. Okay, so these are some examples, few examples. Now economic cost means a combination of explicit and implicit cost and the profits. Okay, normal profits means the reasonable profit, the profit which a firm should earn in order to cover up all the costs and earn a reasonable margin. That is normal profit. So that is another concept of cost, economic cost. What is normal profit? It means the minimum income which accrue to the entrepreneur in order to induce him for undertaking the risk. That is normal profit. Okay. Now short period, long period, it is very simple. Prabha, you don't need to note all this because these are very simple terms. The main types of costs are other costs. Okay, so short run and long run, they depends on the time period. So short run costs may not be fixed in the long run. In the long run, no costs are fixed. All the costs are variable. Variable means they'll keep on changing. Now we can see that in detail. The short run period implies that period during which some factors of production cannot be changed, even with the change in the level of output. Example, the land, that we already know, short run and long run. And in the long run, all the factors can be changed. Did you see the match today? It would have been a working day there, so maybe many people wouldn't have seen. But it was really good, and it was good to see India winning after so many months. Okay, you saw the highlights, Prabha. Yeah, it was a massive win. Now this is the main type of cost which we need to know: variable cost and fixed cost. Okay, because these are the costs which will be taken into consideration in our calculations. Yes, it's a big thing to be happy. It was a big match, World Cup match, then with Pakistan, and that too the first match of the tournament. So all the factors were important. So let's see what is a variable cost. Variable means changing. So it is that cost which keeps on changing, and it is a cost which will be incurred only if the production is taking place. If the production is not taking place, then there will be no variable cost. The best example is the cost of raw material. You will be purchasing the raw material and paying for that only if you are undertaking production. If due to some reasons your production is stopped, the firm is not producing anything at the moment, then in that case there will be no cost for raw material. Okay. The other example is fuel for tractor. The tractor will run only if it will work on the field or if it's needed to manufacture something. So that all. Seeds, the cost of seeds that are put on in the soil, that is all a variable cost, and it is directly related to the production. More the production, more will be variable cost. Less the production, and less it will be. The other term for it is prime cost. Okay. The next is the fixed cost. Fixed costs are those which are incurred whether production takes place or not. So in the long run, there are no fixed costs, because in the long run everything is variable, everything can be changed. So it can be a cash or a non-cash expense. The example is depreciation on tractors and buildings, as discussed. Then the rent on land, and it is also known as overhead costs. Like suppose there is a brick kiln. You understand brick kiln? The place where bricks are made. So if a person is the owner of the brick kiln, so he will be paying for the tractor, then for the like the soil which he'll be getting for manufacturing or making that brick, that all will be his variable cost. But if he is having a tractor and that tractor is standing, it's not since it is rainy season, so the kiln has been shut down. It will not operate for the upcoming 3 months. So in that case, the cost of tractor, the depreciation on the tractor that is continuously taking place, that is a fixed cost and it cannot be avoided under any situation. Okay. Then the other example is like if he has appointed an accountant in the office, so whether or not there is manufacturing going on in the kiln or not, accountant will be paid his salary. We cannot say no, we will not pay you for 3 months because we are not working right now because of the unfavorable weather conditions. We'll have to pay them. So that is a fixed cost. Alright. Similarly, the rent on land, rent of building, the fixed cost of the telephone, the fixed cost of the electricity, these are all fixed costs and they have to be paid. If we have appointed a guard on the door, he'll be paid for 12 months. He's not bothered we are manufacturing or not. Okay. So that is a fixed cost. So fixed cost is not dependent on the production. It does not vary with that. Alright. So now let's go to the next one. So what is total cost? It is the total of fixed and variable. So this is the formula for total cost. Total cost is equal to FC plus VC, that is fixed cost plus the variable cost. So this is the difference between the two. The fixed costs are contractually fixed. Thus, even if the output is 0, the firm has to bear these costs. Now, total fixed cost does not depend on the level of output. It remains fixed. If the accountant is working for more hours, or if he is working like normally he works for 6 hours a day out of the 8 hours of duty, and now he is working for 7 hours. So he will not say I am working 1 hour extra, you'll have to pay me more. No. So it is not dependent on that. They do not exist in the long run. and it becomes horizontal. We'll see the plotting of that. Then variable costs are contractually fixed. Thus when the output is 0, the TVC also becomes 0. It depends on the level of the output. It exists both during the short and the long run. And it takes the shape of an inverted S. Okay, we'll be seeing that also. Is it clear, the concept of this fixed cost, variable cost, everyone? Now let's see the plotting of this on a graph. When we are going to plot it on a graph, how will it look like? Okay, so you can see it here. This is the cost and this is the level of output. So this is the total fixed cost, because for any unit of output the fixed cost will remain the same. So it is a line parallel to the OX axis. Okay, it is parallel to this and it will be parallel to X axis. It will be a straight line. So it's total fixed cost. Now comes the total variable cost. Now this variable cost will start from 0. It will be 0 for 0 units and it will go on increasing as the units will increase. Okay, and it is in the shape of a S. It is slightly like this. We can say, oh, that's very bad drawing. It's a, you can see the shape in the graph itself. That is total variable cost. And then next is the total cost. Since total cost, it already includes the fixed cost in it. We have seen in the formula, total cost is equal to total fixed cost plus total variable cost. And total fixed cost is a straight parallel line to X axis. We cannot include it in this total cost in any manner. So what do we do is, we start the total cost from the point of total fixed cost. The total fixed cost and total cost will originate from the same point. So this total cost starts from 50. So that means this 0 to 50 is already a part of it. Okay, so we'll make it look like this. Can I go to the next? Can you just read what's written over here? The first is fixed cost does not vary with the output. The variable cost increases with the production and rate varies with the increasing and decreasing returns. Means it's dependent on the production. Okay, and total cost is the vertical sum of fixed cost and variable cost. Okay, Prabha, you didn't understand fixed cost. Okay, fixed cost is the cost that is fixed by nature. So whether or not we are manufacturing or we are doing our business, this is a cost which will be incurred by the firm. The example is depreciation on the machinery. Whether the machinery is being used, okay, that you understand. You didn't understand this curve, this graph. Okay, so you see the total fixed cost is fixed for every unit. Means you manufacture 10 units, then also you will pay the electricity bill of 1000 rupees. Whether you manufacture 2000 units, again the electricity bill will be 1000 units. So it is fixed for every unit. So that is why it is a line parallel to the y-axis. Okay. I think you are talking about this one. You didn't understand this total cost. This is the fixed cost curve. Prabha, this is the fixed cost curve. You call it total fixed cost or fixed cost. It is the same. Okay? It is the same. And this total cost starts from this point because it includes the total fixed cost in it. It is a combination of total variable and total fixed cost. So it already has that. That is why it starts from a little higher point. Okay. Now I think we can wind up now because just 2 minutes are left for the class to be over. There is no point in starting something new. We can continue with this in the next class. Okay? Is that fine? Yes, everybody. So we can meet in the next class. Thanks for your time and try and make it on time. Everybody who were late today, please be on time so that you don't miss out on important things. So have a great week ahead. Enjoy your upcoming week. Work hard. Stay fit. Thanks for your time. Good night. Bye everybody. And please fill the feedback form which you will be getting. Please go through your textbooks once. Okay? So that things become clearer. And you can clarify your doubts. Alright. Bye then. Good night.